afternoon, everyone. I'm Pamela Hastings, and welcome to another Barometer Readings webcast on this Wednesday afternoon. On today's webcast, we will provide you with a brief, or actually Tuesday afternoon. Dave, help me out here. It's Tuesday. Oh my goodness. Tuesday afternoon. Welcome, everyone, and thanks so much for joining us again. Today, we're going to provide you with a brief macro overview, as always. And of course, I'm joined by Barometer's very own David Burrows, our Chief Investment Strategist and President here at Barometer Capital. At the tail end of the conversation, we'll provide you an opportunity to ask questions, so don't be shy. You can email me on the Zoom link, the Q&A or the chat, and email me at phastings@barometercapital.ca. And with that, I turn the conversation over to David Burrows. Good afternoon, David.
Hey, Pamela, how are you?
Good, thank you. Excited for your overview today, Dave.
Well, it's a perfect day to be doing an overview because, of course, we have one of the more important Fed meetings tomorrow, where we'll get an update on Fed policy. It's widely expected that there will be a fairly substantial rate hike. Probably 85-90% that it's a 75 basis point hike. And of course, everybody's been trying to divine the tea leaves to figure out where things are going from here. I think it's a really interesting time because, of course, over the course of the year, there's been no shortage of things to worry about. And markets have certainly shown that. But I think one of the most important things to keep in mind is that markets spend and investors spend all of their time trying to look out 8 or 12 months and divine what's coming around the next corner. And there has been lots of diligence done by all kinds of market participants to try to assess the risks and, frankly, to make sure that their portfolios line up with their views. I almost wonder what could possibly come tomorrow that people haven't thought and worried about and set up for. So it may be one of those, buy the rumor, sell the news, or on the other hand, actually sell the rumor, buy the news. But I think it's going to be very interesting to see what happens. Of course, we don't know what's going to happen, and all we can do is look at the market internals and look at what's been happening in various neighborhoods in the market and asset classes to try to understand what people are expecting. And, the market is like a big machine. There's 1,000 moving parts. There's some very obvious ones that we can see on the surface, and those are things like interest rates and conflict, geopolitical conflict. But there's all kinds of other things at work, and all of them fit together, and what comes out is market behavior. And so what I want to do today is, as usual, kind of go through a set of steps to look at the different asset classes and what's going on within the asset classes to see if the market behavior is jiving with the commentary. And I think in some ways it's not. And that's important because generally the market gets it right. So our long run view is that we remain in a structural bull market in stocks that started in 2013. And it's important to have an assessment of that because a structural bull market is kind of like 4 steps forward with 1 step back. You have these painful, sharp drawdowns, but they don't tend to last too long. And the advances can be extended. And very often the entire way through, it will look expensive relative to recent history. And that's an important concept to keep in mind. You never wind up with a cheap market in a structural bull market. Conversely, in a structural bear market like the one we had between 2000 and 2013, you have very prolonged, deep declines, 35, 45, 50%. They go on for a long time. It's more like 1 step back, 1 step forward, 1 step back, 1 step forward. The market doesn't make much progress. And of course, that tires out investors. It means a lot of people ultimately leave the market and go and do other things, maybe focus on other asset classes. We had a market like that between 1966 and 82. We had a market like that between 1929 and 1950. But when we hear discussion about the fact that we're going to see rising rates, and that means stocks have to go down, I like to point out that in the period between 1948 in 1952, you did have a very serious bout of inflation. You did have a recession, but the market actually worked its way higher. And then there was a series of rate increase cycles in the 1950s and early 60s. And inflation would ebb and flow, but markets made a lot of progress. But in that period, actually, fixed income gave a zero net real rate of return over that period, in a period where you would expect, maybe you had an opportunity with some rising rates. So it's an interesting time. So equities, we still believe we're in a structural bull market. We'll bat that around a little bit. This is what we've been going through since the beginning of this year. Markets made a lot of progress since it started the bull market in 2013. But at 115 months, that would be about the shortest structural bull market in history if it's over, and it was over actually 6 or 8 months ago. You had a long drawn out period of weakness in 1994 where the market made no progress for a year, but consolidated and corrected during a rate increase cycle. So this is not unprecedented. When we look at the channel that the S&P has been in, really since the beginning of this bull market, we continue to be in that channel. We certainly are bumping along the lower bounds of that channel. And if we were to break significantly below there and stay below, that's something that we're going to have to assess. That's not the case as it is right now. And going back to this longer term chart, you can see we've been healthily above this rising 200-week moving average all the way through, as you tend to do through a structural bull market. Again, structural bear market looks quite different. Now, a few weeks ago, we talked about the fact that the market had a good summer rally from the end of June up toward the declining 200-day moving average, that we had become extended above the 50-day moving average, and likely we could pull back, as we often do after that is the case. And here we are today. Now, one thing that I do have to note this week is that after holding this series of lows over the past week, we did break that low. So, as you know, our indicators have been that breadth has been contracting. It means that we don't add new positions. It means that we use the stop losses that we have on individual positions to manage downside. The stop losses are placed at inflection points using point and figure charts, where we go from being in a series of higher highs and higher lows, or an uptrend, to breaking a previous low and going into lower lows and lower highs. And they're aimed at helping us to make sure that little mistakes don't turn into big ones. So we do have a little bit more cash than we did last week. As we said, we got to take this step by step. On the rates front, we've had the belief since 2020, we went through a generational bottoming in yields, that rates started falling in 1981. And we've been highlighting that what works during falling rates generally is quite different than what works during rising rates. And so our view is we are back in a rising rate environment. And you can see that pretty clearly on the 10-year yield chart. Going back to 1981, we reversed in 2020, got above the long-term moving average early in the summer, pulled back for a few weeks, and we moved higher from there. So today, the 10-year yield is at 3.57%. And really across the curve, whether you looked at 2-year bonds or 5-year bonds or 10-year bonds or 20-year bonds or 30-year bonds, yields have moved higher across the curve. What that means for bond prices is that the bond market has been a place we've avoided now since 2020. This is a 10-year to 20-year bond ETF where the price has fallen from 175 to 112 over the course of about 2 years. That's a big decline if you're a fixed income investor. And ultimately, yes, it will come mature at par, but what do you make over time, or what return do you get when there's inflation deflating the value of your currency? If you look at the history of returns from global bond markets, this has been a doozy. In fact, you got to go back to that period of a heightened inflation period after the Second World War to have seen a return like the one we saw just now. Well, this is coming out of a pandemic. That was coming out of a world war. Both had big surges in demand. Both had constrained supply. In the case of the early 1950s, that constrained supply for many goods and services resolved itself after that first bout of higher rates. We'll see whether this one does too. But again, you have to understand what can happen to understand what might happen. So interesting to think about. We've had a view for some time that we saw a secular bottoming in the return or the price of commodities versus the stock market, like we did in 1999, 2000. And again, in 99 through the next number of years, what worked leading up to that point did not work. Tech stocks had a horrible number of years, while actually old economy, value, and resources had a 15-year bull market. So there's the Rgi Index, which we continue to put up on the screen. This is breaking the trend in the beginning of 2021. We've corrected a little over the last 4 months. In fact, we're at about the same level we were at a week ago and about 2 weeks before that. The Rgi has had good, strong relative performance versus stocks. So again, this is a basket of commodities equally weighted, agricultural, metals, so on. And the relative strength versus the S&P has been rising pretty sharply since December 2021. It was rising before that. And through this little sell-off we've seen recently, we're trading very close to a relative strength new high going back to the beginning of summer. And commodities continue to outperform. So as an asset class, this is kind of one we have to continue to look at, because when relative performance starts, it can go on for a long time. There's the ETF for Brent Crude. Now, the strongest area, or one of the strongest areas for commodities, has been energy for obvious reasons. We had very little investment made in production capacity from 2014 through 2020 as oil sort of collapsed and the Rgi Index went down almost 90%. Producers. We've seen good relative strength for oil since the bottom in 2020. Still on the year, trading better than 89% of all the individual constituents in the S&P 500. Trading above long-term moving average. And hanging in well relative to the market. When we look at agriculture, it's actually been stronger recently. Look, good sharp pickup in relative strength versus equities, and certainly versus fixed income. That agriculture basket is up about 6% on the year so far, against an S&P down about 20. We highlighted last week that agriculture had just recently taken over the top spot in the commodity complex over energy, precious metals, and industrial metals. Taking a step further, last week we talked about the real estate asset class as being one of those assets that was really helped by falling rates, certainly not helped by rising rates. In a lot of cases, these are levered assets. We looked at the real estate development universe of companies in the US as hitting a new relative strength low. Somebody was asking me this week about real estate investment trusts, which of course are different, but in the same asset class. So to put that up, we hit a new relative strength low today versus the stock market. This group is now down 26% on the year. So this really has not been a viable place to have money placed. So fixed income, very, very difficult. Real estate, very difficult. Equities, I've had a tough year, and commodities are having a more favorable year. So we don't have to be everywhere. I put this up from time to time. This is a quilt, an asset class quilt. And you can see, based on the year, different things do well in different years. In 2012, emerging markets was the place to be, and international stocks, then REITs, then large cap US stocks, small cap, mid cap, equal weight, inflation protected bonds, cash, and commodities. Now, one strategy is to say, okay, we're just going to have a little of everything, and we're going to have a very broad, diversified portfolio, and that's one approach. That's not our approach. Our approach is try and understand the backdrop and skew the investments in a diversified way to the things that have a structural tailwind, which is why we spend so much time talking about structural bull and bear markets. I think the people who are hiring us expect us to add some value by trying to identify those structural themes that are being revalued favorably and avoid the ones that are being revalued in a negative way. We need to find the market leadership, and that could be sectors or themes or asset classes or specific styles like growth or value. We got to always be watching for change, new leadership to emerge. And in the absence of leadership, have an ability to be on the sidelines with some or a lot of the portfolio or avoid big parts of the market. So we're being paid to be tactical. Now think about it. We've just had a decade or more of quantitative easing that created a hurricane as a tailwind behind almost all asset classes. We are not in that world today. During that time, passive investing became a very positive thing because people said, well, for a low fee, I can just own the exposure to the asset class and buy a basket of most assets, and over time, I'm going to do fine. And that's true. But if you think about it, as time goes by in those indices, the things that were helped most by interest rates became the biggest parts of those industries. And now that we have rising rates, those things that get hurt by rising rates are the biggest parts of the index. So this is a great time to be a tactical or targeted or an active investor. In our world, we believe that 80% of return comes from getting to the right asset class. So say commodities and equities or certain parts of equities, and identify the sectors or themes that are benefiting from the structural changes and avoid the ones that are getting hurt. So 80% getting to the right neighborhood, 20% finding securities to express that view. So our top-down work takes all the various areas we could focus. We have a very broad mandate. We can go anywhere, but boil that down using our tools to identify those that are most favorable and those that are seeing net inflows of capital as being the areas that we would focus on for new investment. The bottom-up work, which my partner Greg focuses on in our investment team, is to take all of the various securities we could use to express the view and boil down to a set of securities that what we consider are good getting better. They're fundamentally sound and improving, but also that have price characteristics that would support that view. So we can find securities that meet our business tests in areas of the market that we see as having net inflows. Well, that's where our portfolio is going to live. The third piece of the strategy is probably the most important piece, and that is this is a living, breathing basket of securities. We have to reevaluate each security every day. The most important thing we can do is recognize when something changes for the worse and be prepared to make an exit. We only need 30 to 40 securities to build a portfolio, and there's 60,000 to choose from. So we need to be a good seller. We got to manage the inventory in the portfolio. So we use stop losses to help us manage risk and make sure that a little mistake doesn't turn into a big one. So I go through that regularly because I want to understand people to understand the lens that we're looking through. These are all important pieces. The top-down work is about finding parts of the market that are showing expanding breadth, meaning more and more constituents within a universe of securities are performing well. The leadership is broadening. That means money's getting put to work. When leadership starts to narrow or the weaklings start to fall away in a group that has been leading, that tells us there's money leaving the group where the risk levels are rising. Every bear market in history has been led by deterioration in breadth. So it's important to recognize when that's taking place. When breadth is deteriorating, you don't put new money to work. Right? You wait until you see new leadership emerging. Okay, so let's talk leadership. Last week, we highlighted that our long-term indicators, for the most part, were weakening. If we took all US stocks, the percent of stocks in uptrends was around 48%. And the percent of stocks in uptrends globally was around 45%. Percent of stocks in uptrends in Canada had been expanding and was not contracting at this point. In other words, this was a universe of securities that actually doing better than the rest. When we looked at percent of stocks above their 50-day moving average, it's contracting, not helpful. Percent of stocks with positive momentum, contracting, not supportive. Percent of stocks making new highs versus new lows, falling. And the percent of stocks trading above the 150-day moving average or 30-week moving average, falling. is for the NYSE. Well, let's look at it today. Well, the numbers are lower. So breadth has continued to contract. But it's important to recognize that despite the fact that all of these companies are in downtrends, there are still a considerable number of securities that are performing well. Just because there's more and more securities doing poorly doesn't mean we sell everything. It means we have to continue to be critical of our existing positions, and we don't want to be adding new ones because it's easier to make a mistake. So as we come into the Fed, the market has been moderating and investors have been repositioning. Through the course of the war with Ukraine, investors have been repositioning. None of this stuff is new. If the Fed raises 75 basis points tomorrow, it's probably the most widely discussed Fed meeting that I can remember. The question is, what else might they say to give us additional guidance going forward? What I would say is that when the market made its low in June, only 20% of stocks were in uptrends. This is a reading of breadth going back to 2007. I've got it back to 1955. You can see that breadth made a considerable low, in March of 2020 at the COVID low, and reversed up. It was time to get invested. When it made a low in December of 2018, we all remember the fourth quarter of 18. When it reversed up in January, as scary as it was time to put money to work. When it reversed up after the contraction in China through 2015-16, it was time to put money to work. Similarly, when it turned higher ultimately in April of 2009, time to put money to work. So we turned higher in June. We rallied through July and August. Breadth has contracted over the last month. I think it's important to recognize that many more stocks are in uptrends right now than were in June of 2022 at the most recent low. What we want to see is when markets make lows, if they retest those lows, can fewer stocks break down? As it stands right now, that is the case. We'll see what happens as we go forward. When we look at Canadian equity breadth, it bottomed in July and has been moving higher since then and has not shown any deterioration since then. Could have something to do with the makeup of our Canadian market versus the US market, different sector weights. And certainly some of the sectors that are doing better are larger parts of the Canadian market. So for the TSX 60, this is relative strength versus the S&P. It has been moving smartly higher over the last few weeks. And in the time while the S&P pulled back about 10%, it's pulled back about 5% over the last 23 days, way outperforming. It's important because we live in Canada. We have lots of Canadian investments, and we've targeted Canadian sectors because they tend to be a good representative of things like energy. When we look around the world, last week, all of the markets in green were showing expanding breadth. You can see the list is a little smaller today, but Latin America, Brazil, Indonesia, and Canada all remaining positive. It's interesting to me that all of those have significant components in energy and basic materials. I think the big discussion has been recently not so much about inflation, but about whether the rate rise cycle would cause a hard landing. And I think that a lot of investors have been positioning for that. So it's interesting that the markets are more resource driven, are actually outperforming. That's a bit of a non-confirmation. We look at the sectors, XEG, which is the Canadian Capped Energy Index, continuing to see improving relative strength versus stocks, up 46% on the year so far. And that's against a backdrop where the US government has been selling their strategic reserve into the market. In July, it was 656 million barrels in inventory. Today it's 434 million barrels. How much can they sell down? In the last week, they said, well, if oil were to go to $80, we probably would start restocking the strategic reserve. We're at $83, $84 today. So there's a bit of a backstop here. I think it's very interesting that despite all of those barrels coming into the market, oil price and energy stocks have held up quite nicely. Markets obviously looking beyond the sell-off from the strategic reserve. Now, oil and gas versus tech stocks ratio started to outperform about 18 months ago. We said that when it starts, it tends to go on for a long time. It continues. And when we look at it year to date, this is what's happened to the basket of oil and gas companies in Canada versus a basket of technology stocks in the US. The divergence continues to widen. When we look at the point and figure chart for the oil and gas sector, we continue to see higher lows and higher highs. Continues to be constructive despite what concerns there may be out there about demand destruction and a hard landing in the economy. Market is not seeing that at this point. I'm sure there are people looking for it. Clean energy continues to perform well and has all year long on a relative basis versus the S&P. We talked about industrials over the last while. We've been seeing some improving relative strength on industrials since March, but this past week or so, we did see a bout of weakness. So again, I always like to focus and try and understand what parts, what are the subgroups. Transportation this week had a horrible week on the back of FedEx's warning. But we've spent a lot of time talking about defense, and defense relative strength continues to improve versus the market. The subgroups are important. So defense has been a big area for us. And, you know, it's down about 3.6% on the year versus the S&P down 20. Other groups, financials, relative strength continues to improve. I just am having a hard time squaring why it is that financials are improving relative to the market and energy is improving relative to the market. These are highly economically sensitive groups. If we're going to have a hard landing or some kind of a crisis, you would expect these would be underperforming. The investment banks in particular, most closely tied to the market, Morgan Stanley, Goldman Sachs, Charles Schwab, Raymond James, relatively outperforming on a consistent basis since March. So these are important clues to take away. Insurance companies' greatest source of earnings are the returns they generate on their investment portfolios, but relative strength continues to improve. Now, the other end of the barbell for us over the last number of months has been dividend payers. This is the FDL ETF, which is made up of a basket of dividend payers, and they are a combination of consumer staples companies, utilities, and some energy companies. And relative strength continues to improve, down only 1.4% on the year. That's the point and figure chart, a steady move higher and higher highs and higher lows. So the utilities group continues to have strong relative strength. It's a very defensive group. This is the barbell in our portfolio, the defensive side. Consumer staples are the same picture. And this week we were looking at energy infrastructure. Now this is an ETF that is made up of limited partnerships, which tend to be pipelines in the US. And again, very strong relative price strength as the pipelines are in Canada. So dividend growth is a camp that we always like to focus on because it tends to generate strong returns, dividend growth relative to other cohorts with significantly less risk, and that continues to be the case this year. Okay, things that we continue to avoid. We talked last week about how the QQQ, or the NASDAQ 100, was relatively underperforming the equal weight S&P 500. The tech sector continued to weaken this week, made a new relative strength low versus the market. Now, if we thought that the economy was going to weaken and that earnings growth was going to be at a premium, we might want to pay for consistent growth. That's not the case. Market is not paying for that. I think the market is telling us that this inflation is going to be more persistent, that higher rates are going to be more persistent. The bond market's telling us that. The financial sector is telling us that. The commodity sector is telling us that things may be a little more sticky than people think. And tech is continuing to underperform. Communications, a growth sector with companies like Meta or Facebook, Google, so on, making new relative lows this week, down 13% over the last 25 days. And, you know, Facebook just continued to weaken this week. And real estate, another long duration asset, again, made new relative strength new lows this week. So it's a very bifurcated market. And the problem is, if you own the index, consumer discretionary, real estate, technology make up big parts of the market. So something that is changing a little bit, consumer discretionary has shown some relative improvement over the course of summer. Has been more neutral relative to the market. When again, we look internally, the one group that sort of stands out to us in this area are the entertainment and leisure companies, like the chain restaurants, the gaming companies, the casinos, and travel companies. It's not enough to make us put really new money to work at this point because our Brent models have been weakening, but that's something just to keep in mind. It might be an area that could improve. And again, if we're going to have a hard landing or having a hard landing, that's not really showing up in the data. So, here we are, we're the day before the Fed meeting. We've sort of made our bets. We've been doing this in a very consistent way. We test each week to say, do our weightings make sense? And there's a couple of changes here. One, for the last week, our exposure to very short-term government bonds, in effect almost like T-bills, is up to 15%. We've been stopped out of a few positions, and that means our cash weighting is higher. If we put that together with cash itself at 4%, that's roughly 20% of the portfolios. And about 4% is in short-term corporate bonds, so 24% is flexibility. Energy continues to be about 15%. Industrials continue to be about 13%, as I mentioned before, largely defense stocks. Financials are a little over market weight at 13%. Utilities and consumer staples are still significant overweights in the portfolio from a defensive standpoint. Healthcare is about half market weight. And then at the other end of the spectrum, technology is a zero weight. Let's see if I can get that right. There we go. Technology is a zero weight, down from 4% last week. Consumer discretionary, half of 1%. Real estate at 1.8%. And materials is about a market weight, 2.5%. And we highlighted the fact that we just don't have so much because it is a more volatile part of the market. And we'll see whether, in fact, they can continue to outperform. Communication services, again, a really small part of the portfolio. So it's a very bifurcated world we live in. We're listening to the message in the market. We look for change. And at this point, I think that we continue to be sort of positioned in the right way. We have a very large overweight in the Canadian world because of our sector exposures. And outside of Canada, we still have exposure to Japan, as the currency hedge Japanese ETF, marching slowly ahead. India has had nice, sharply rising relative strength and strong outperformance versus US market. And Indonesia, which we talked about 2 weeks ago, has continued its strength. Relatively small weights. Europe is a short, continues to see weakening relative strength and weakening currencies. So look, we can get caught up in just staring at what the index is doing. And I would say the index is showing us we are having a typical bull market correction or a bear market in a secular bull market. And these are painful. We have to listen to the market. We have to position accordingly. But at this point, we don't think that we are in one of these waterfall declines that we worry about every day. And people have had lots of time to position. Sentiment is extremely bearish as it ever gets. The amount of money that's been spent buying protection in portfolios by institutions is off the charts. When we look at the percent of money managers who are overweight equities, it's about as low as it gets. It's lower than it was at the worst point of the financial crisis. And things that really don't square with the fact that we're in a crisis, volatility. Volatility at 27 is way lower than where we were during COVID, way lower than where we were in the 2018 taper tantrum, way below where we were at the worst point of the global contraction in 2015-16, way lower than where we were in the European debt crisis, way lower than where we were in the financial crisis. Now, these things can change, but the signaling to me is that we are not in a crisis. The credit spreads are not widening and are nowhere near where we were, even approaching in the financial crisis. So we'll see how the market reacts tomorrow. We are still in a tricky time of year. We talked about the fact that we have to assess this day by day. I think on some days, clients would love to hear that we were 100% cash. The problem is, if you were 100% cash at many of the past turning points, you got left behind for 10 or 12% over the course of a few days. We're just not willing to take that risk. There's risk of being in the market when it's falling, and there's risk of not being in at all when it's rising. As long as the sectors that we are in continue to be constructive, we're comfortable being invested, and we'll retest them every day. But we do have a history of being defensive when markets are difficult, and we are. We have a significant cash weight, and there's big parts of the market that we're avoiding. So Pamela, if there's any questions, happy to answer them. And I'm sure we'll know a little bit more over the next few days as to the course of things. But this is what I can take away from the way the market's acting today.
Thanks so much, David. We just have one question here. The question comes from Lawrence, and he wants to know what ETFs, short-term bonds you use to help your US cash while waiting to move back into equities.
Well, we've used some 1-year T-bills. We've used in Canada, we've used XSB, which is 1 to 2 year government bonds. They trade in a range of pennies back and forth because they're such short duration. That's a good one to take a look at for Canadian dollars. But you know, there's lots of short-term bond ETFs out there that you can take a look at. I just think it's good to have a little flexibility. And frankly, you know, we're getting close to 4% on that money today. So it's not so bad. It's, you know, realistically, the very short-term bonds are an option for someone to get some return while they're waiting right now. The problem is you don't want to take too much money and pile it there, because if you were to get even a short covering rally or a significant bounce, you know, you can make that return up in a few days. But that's what we're doing with the cash.
That's great. Thanks so much for the insight, Dave. And on that note, I will leave it there because we don't have any further questions. So thank you so much, David, as always. We'll see you back here next Tuesday.
Okay.
And,
well, as we get more information, we'll keep you up on it. And, you know, don't hesitate to follow us on Twitter at Barometer CA. We put up some thoughts there. And if nothing else, we'll see you next week.
Thanks, David. Have a great evening. Thanks everyone.